This chart shows two graphs. This is the stock market, and this is the yield curve taken as a difference between the long-term interest rates minus short-term interest rates. So this is positive, which means the yield curve is steep, is normal yield curve. When instead the difference is negative in this area, that means that short-term rates are above long-term rates. These are periods of recessions, this, and this. So what you see basically is what we know, that when the yield curve is flat, that is short-term interest rates are equal to long-term interest rates, or inverted, that is when the difference is negative, what you should expect is a pretty sharp slowdown or a recession. Now, which is what is happening right now. But the purpose here of this chart is to show you a way of looking using the yield curve to find out when the bottom of a bear market is going to happen. So if you look at the bottom of a bear market and then you go up, you see the difference between long-term and short-term interest rates is 1, which means 1 percentage point, or otherwise 100 basis points. Here, the bottom of this bear market is when, again, the yield curve is normal, that is, short-term interest rates are below long-term interest rates, and the difference is roughly, yes, 100 basis points. In this case, the bottom of the bear market is when the yield curve is normal. Not only that, but the difference between long-term and short-term interest rates is 200 basis points, or 2 percentage points. The bottom of this bear market is the same thing. So what am I saying here? Is this the bottom of a bear market? I don't think so, because the yield curve will have to go up here in positive territory, that is, with short-term interest rates below long-term interest rates, and the difference be close to 50 or 100 basis points at least. So we have room to go here. I thought this was quite interesting, quite frankly. Okay, I hope you enjoyed and you found this presentation useful, and I hope really to see you very, very soon. So long.